Today, peak inflation, really? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, overnight we got the latest read on inflation from the US. The Consumer Price Index, or CPI, climbed to 8.5% in the 12 months through to March. That's above the economists' forecasts of 8.4%. In fact, some are suggesting that we're now reaching a peak, but that is more hope than data-driven, in my view. In fact, it was the core CPI, which excludes food and energy, that dominated investor attention. The core CPI rose 0.3% in March. That was slower than economists' forecasts for a rise of 0.5%, and it was led by a larger than expected decline in core goods prices, alongside a surprising miss in rents, Morgan Stanley said. Core CPI, which strips out volatile food and energy prices, along with other major indicators, did continue to soar, though, well above the Fed's average annual 2% inflation target. And I'd make the point that with inflation so broadly spread, I wonder why they strip out all of those volatile items. It seems to me that they might be hooking their story a bit. Some on Wall Street aren't getting carried away, warning that there is still a long way to go for inflation to return to the Federal Reserve's 2% target. While today's report is encouraging, the Fed is a long way away from claiming victory and will have to remain in inflation-fighting mode, Jeffrey said in the note. The Labour Department's CPI report showed that prices urban American consumers pay for a basket of goods posted the biggest monthly jump since 2005, giving that annual surge of 8.5%. That's the hottest year-on-year inflation number in more than 4 decades. Much of the top-line CPI growth was attributed to an 18.3% monthly surge in gasoline prices to a record high of $4.33 per gallon. The report did little to budge the needle of expectations regarding impending interest rate hikes from the Federal Reserve. It's a reiteration that the Fed can't be sitting back here. They need to get moving post-haste. US consumer prices rose in March by the most since late 1981, underscoring the painfully high cost of living and reinforcing pressure on the Federal Reserve to raise interest rates even more aggressively. The Consumer Price Index increased 8.5%, as I said, from a year earlier, following a 7.9% annual gain in February. The widely followed inflation gauge rose 1.2% from a month earlier. That's the biggest gain since 2005. Gasoline costs drove half of the monthly increase, while food was also a sizable contributor, as Americans paid more for vegetables, meats, and dairy products. Excluding volatile food and energy component, the so-called core prices increased 0.3% from a month earlier and is 6.5% from a year ago, due to, in large part, a drop in used vehicle prices, the biggest since 1969, and the deacceleration in price growth in other merchandise categories. Used car prices, which had been a driver of higher goods inflation for months, were down 3.8% in March, the second straight monthly decline. New car prices, meanwhile, rose slightly. The figures are a welcome respite from the sustained heated core increase of late, and fuel costs look to ease in response to the recent pullback in oil prices, Sal Guttaria, senior economist at BMO Capital Markets, said that. However, food, rent, and a few other items look to remain troublesome and act to slow the expected retreat in inflation in the year ahead. The March CPI reading represents what many economists expect to be the peak of the current inflationary period, capturing the impact of soaring food and energy prices after Russia's invasion of Ukraine. The report showed goods inflation stayed elevated while services continued to advance. On a year-over-year basis, goods inflation, excluding food, energy and used vehicles, rose 8.1% in March. That's the most since 1981. Food prices rose 1% from February, and prices for household furnishings and supplies rose 1% from February after outsized gains in recent months. The index of furnishings and operations jumped 10.1% from a year earlier. That's the most since 1975. Services costs increased 5.1% from a year ago. That's the biggest advance since 1991. Airline fares rose a record 10.7% in March from a month earlier, and shelter costs, which include rents and hotel stays, rose 0.5% for a second month. Inflation is predicted to stay near 6% by the end of the year, which will keep pressure on the Fed Chair Jerome Powell and his colleagues. The central bank is expected to hike interest rates by 0.5 point at its next policy meeting in May, and possibly at one or more meetings after that, while moving forward on plans to reduce its balance sheet. While the Fed has opened the door for a 0.5 percentage point increase in interest rates, inflation isn't likely to recede to the central bank's 2% goal anytime soon, especially given the war, COVID-19 lockdowns in China, and greater demand for services like travel. And remember, Americans are also struggling because wages aren't keeping up with inflation, even as employers boost pay to attract and retain workers. Inflation-adjusted average hourly earnings dropped 2.7% in March from a year earlier, the 12th straight decline, according to separate data also released on Tuesday. Now, the Dow reversed gains to close lower on Tuesday as tech's attempt to rebound failed following data that fueled debate on whether inflation was indeed nearing a peak, reversing earlier gains as impending monetary tightening from the Federal Reserve once again pulled growth stocks back into the red. All three major US stock indices turned from positive to negative early in the afternoon, weighed down by healthcare and financials. In fact, though, the turnabout began in earnest shortly after remarks from Fed Governor Lael Brainard, who reiterated the need for the central bank to expeditiously take on decades-high inflation. The comments coming out of the Fed officials have been much more hawkish than the markets had anticipated, said Paul Nolte, portfolio manager at Kingsview Asset Management in Chicago. Brainard has generally been nondescript, but now she's more forceful in her commentary, and that's getting people to sit up and take notice. The Dow Jones Industrial Average fell 0.26% to 34,220. The S&P 500 was down 0.34% to 4,397, and the Nasdaq Composite dropped 0.3% to 13,371. US Treasury yields took a breather, though, following the data, briefly helping growth sectors of the market, including tech, to catch a bit earlier on. Earlier session gains, though, were dampened after a poor $34 billion 10-year US Treasury auction, which helped benchmark yields to bounce off session lows. Energy stocks were the biggest gainers in the wake of surging oil prices as global demand worries ease after Shanghai curbed some of its COVID-19 restrictions. They enjoyed the largest percentage gain amongst the 11 major sectors of the S&P 500, jumping 1.7% on the back of those surging crude prices with both WTI and Brent higher. First quarter earnings seasons will burst through the starting gate later this week, with the big banks leading the way. Bank stocks, though, struggled a day ahead of JP Morgan's quarterly results, as those, of course, are impacted by falling Treasury yields. Analysts have curbed their first quarter optimism. In fact, annual S&P 500 earnings estimates was recently estimated to be 6.1% down from 7.5% at the beginning of the year. And sentiment was also hurt by fading hopes of the Russia-Ukraine ceasefire as both sides prepare for an intense battle in the eastern Ukraine region of Donbass. And finally, the New York Fed's underlying inflation gauge, the UIG, which seeks to capture sustained movements in inflation from information contained in a broad set of price, real activity, and financial data via 2 monthly estimates of trend inflation, shows, well, that things are not good. The first derives a measure from a large number of price series in the Consumer Price Index, as well as macroeconomic and financial variables. The second employs the prices-only dataset. The UIG full dataset measure for March is currently estimated at 4.9%. That's a 0.1 percentage point increase from the previous month. The prices only measure for March is currently estimated at 5.8%. That's a 0.1 percentage point increase from the current estimate for the previous month. And the 12 months change in the March CPI was up 8.5%. That's a 0.6 percentage point increase from the previous month. And for March 2022, the trend CPI inflation is estimated to be somewhere between 4.9 and 5.8%, a range similar to February, but with both its lower and upper bounds 0.1 percentage points higher. So the question is peak inflation in them? Well, used car truck prices fell 3.8% for the month, which is the second consecutive monthly decline, and a welcome sign perhaps that the supply side shocks could finally be fully priced. So is inflation moderating as yields come in following the not so terrible inflation report? It's hard to be overly optimistic about the US consumer given the significant declines in real average weekly earnings, widespread gains across food, energy and shelter, and geopolitical uncertainty that could keep commodity prices elevated. As Ed Moyer put it, inflation will take care of itself if geopolitical risks improve, and expectations should remain that the Fed won't have to aggressively tighten policy and send the US economy into a recession. But realists may well prefer to take a more sanguine view. As supply chains remain choked, oil supplies are under threat, and real wages are falling, perhaps it's a question of which breaks first as the Fed lifts rates, the consumer, the bond market, or equities. Because indeed, risks abound, and in my view, inflation has a long story still to tell. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.